You saw our video about the petrodollar. You understand how the system worked. Oil is valued in US dollars. America maintains its dominance. For 50 years, that was the deal. You watched our video on the Strait of Hormuz. You understood the weapon. 21 miles. 20% of the world's oil. Iran's hand on the switch. March 14, 2026. Iran flips the switch. Not to close the strait, to turn it into a toll road. A Yuan toll road. The announcement was simple, devastatingly simple. Oil tankers may pass through the Strait of Hormuz. On one condition, the cargo must be paid for in Chinese yuan, not dollars. Yuan. In one sentence, Iran didn't just block oil, it tried to kill the currency that oil runs on. But here's what nobody is telling you. Iran didn't think of this alone. This plan has been 10 years in the making, and it's executing right now, in front of your eyes, in real time. Let's be precise about what happened. Iran didn't close the strait entirely, it discriminated. Ships bound for China unmolested, waved through, no problem. China receives 40% of all oil passing through Hormuz. Those tankers kept moving. Everyone else, pay in yuan or stay out. That's not a blockade, that's a forced currency conversion. At gunpoint, on the world's most important energy choke point. Here's what the US faced in that moment. Option 1. Force tankers through militarily. That means shooting at Iranian assets. That means escalation. That means a wider war. Option 2. Negotiate with Iran. That means acknowledging Iran's leverage. That means diplomatic concessions. That means weakness. Option 3. Do nothing. Let the yuan flow. Let the petrodollar crack. There is no good option. That's what a trap looks like. And this trap was not designed overnight. It was engineered, over a decade, by the one country that benefits most, China. To understand what's happening, you need to understand what China built while nobody was watching. In 2015, China launched CIPS, the cross-border interbank payment system, a yuan-denominated alternative to SWIFT, the system that processes all global dollar transactions. In 2018, China launched yuan-denominated oil futures on the Shanghai International Energy Exchange. For the first time in history, you could buy and sell oil in a currency other than dollars. Legally, transparently, at scale. In 2021, China signed a 25-year cooperation agreement with Iran, worth $400 billion, priced in yuan, not dollars. In 2025, China's CIPS processed $245 trillion in yuan transactions. Not million, not billion, trillion. Yuan now settles 30% of all of China's $6.2 trillion in global trade. Look at what was built: a payment system, an oil exchange, a long-term supply agreement, decade-level financial infrastructure. All of it designed to move oil in yuan instead of dollars. Iran didn't wake up on March 14th and say, "Let's try yuan." Iran executed the final step of a plan China laid 10 years ago. The petrodollar was always China's target. The Strait of Hormuz was always China's leverage point. Iran was always China's instrument. That's the story the headlines are missing. This is what this channel is for, not the headline. The architecture beneath the headline. The 10 years of decisions that made today inevitable. If you're not subscribed yet, do it now. Because this crisis is not over, and the next chapter is already being built. Let's talk about America's position, because it's worse than most people realize. The US dollar is still the world's reserve currency. 88% of global currency transactions still involve dollars. Oil is still priced in dollars on global markets. So why is this dangerous? Because the petrodollar doesn't just need to collapse to hurt America, it just needs to crack. Think about it like this. If 10% of global oil trade shifts to yuan, that's less demand for dollars. Less demand means a weaker dollar. A weaker dollar means imported goods cost more. More expensive goods means inflation. Inflation means the Fed raises rates. Higher rates means the US government pays more on its $36 trillion in debt. More debt service means America can borrow less, build less, project less power. A 10% shift in oil settlement currency sets off a chain reaction through the entire global financial system. And the US military cannot bomb a payment system. That's the genius of China's move. You can't sink CIPS with an aircraft carrier. You can't sanction yuan. You can't intercept a currency transaction with a missile. For 50 years, America's financial dominance was protected by geography. The Strait of Hormuz, the dollar, oil, all aligned, all American. Iran and China just separated them, permanently. Here's where it gets real. Because nations are already choosing. Right now, today. China obviously is accepting yuan. It was the plan. Russia already settling energy exports in yuan and rubles since 2022. Sanctions accelerated what China started. India, the world's third-largest oil importer, has been quietly expanding rupee-based oil settlements. With Russia, with Iran. India doesn't want to be dependent on either Washington or Beijing. But yuan is less hostile to Delhi than a US-controlled dollar system. Zambia already accepting yuan in mining tax payments. A nation whose economy runs on copper exports, just changed its currency preference. Brazil, the world's largest agricultural exporter, already conducting yuan-settled trade with China, the largest buyer of Brazilian soybeans and iron ore. These aren't radical anti-American nations. These are pragmatic economies making rational choices. When the dollar system is disrupted, when oil shipments stop, when inflation spikes, nations ask a simple question. What keeps my economy running? And more, the answer involves yuan. The petrodollar survived the 1970s oil shock. It survived the 2008 financial crisis. It survived every previous challenge. Because there was no credible alternative. There is now. Here's the question that matters. What does this mean for you? If the petrodollar weakens, the dollar in your pocket is worth less. Not immediately, not overnight, but systematically, structurally, permanently. Oil at $111 per barrel, where it sits today, is already hitting you. Every product transported by truck, every flight, every utility bill, every piece of plastic manufactured anywhere, it all costs more. That's the first wave, the oil price shock. The second wave is the dollar wave. If global demand for dollars falls, the Fed loses some of its power to control inflation. The exorbitant privilege, as French economists called it, the ability to print money and export inflation to the rest of the world, that privilege depends on everyone needing dollars. If they need yuan instead, that privilege shrinks, and the inflation stays home. That's the hidden tax of a weakening petrodollar. You don't see it in a single price. You feel it in every price, slowly, then all at once. The Harvard economists called it. The IMF modeled it. The data is already showing it. And the decision was made in a 21-mile strip of water in the Persian Gulf. Let's come back to where we started. The petrodollar, built in 1974, a deal between Nixon's America and Saudi Arabia. Price oil in dollars. And the US will protect you. That deal survived for 52 years, through wars, through crises, through the rise of China, but it rested on one assumption, that no challenger could offer the world a credible alternative. China spent 10 years proving that assumption wrong. CIPS, Shanghai oil futures, yuan contracts, Iran agreements, infrastructure, quietly, deliberately, and then Iran closed the strait and opened it again, in yuan. Some analysts will tell you the petrodollar is fine, that the dollar is still dominant, that this is just noise. They're right today, but they're asking the wrong question. The question isn't, is the petrodollar dead? The question is, when did it stop being inevitable? The answer is March 14, 2026, the day it became optional. Optional is how every empire ends. Not with a bang, with a choice. If you haven't seen our videos on the petrodollar and the Strait of Hormuz, watch them now. This video is the third chapter. Subscribe to Wealth Geostrategy. We'll be here when the next choice is made.